Once again, stocks traded within a very tight trading range here today in the United States, but in doing so, we did find new record highs in a number of the indices. We continue to have bullish postures across the board. In fact, we've got some bullish intermediate confirmation signals for the second straight day to talk about. We did have a couple of news stories here of note today. From a corporate perspective, we did have FedEx tumble about 10% off of their earnings announcement. And then from a political perspective, all eyes are on Washington, D.C. as we've got some President Trump impeachment hearings going on here as we speak. But for our trade application example today, I did want to head overseas towards one of the foreign markets for a bullish speculative trade going into 2020. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 18th, 2019. First off, if you're new, welcome aboard. Remember to click subscribe over on YouTube. Also check out our description area where you can sign up for our email distribution list. We also are heavy users of Twitter. My handle is @BrandonVanZee, and I would encourage you to follow me there. Also, thank you to everybody who clicks like and retweet for these Market Outlook related posts. Lastly, we have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts now. As you can see, I've got chart 4B pulled up here in front of us, and this will show us the four major U.S. equity indices. And it was a quiet and calm day for the most part. As you can see, all of these labels right here are blue at the top of the chart as opposed to orange when we talk about what was the daily range versus what was the average true range or typical range from high to low here more recently. And in most of these cases, you can see that our range today was less than half of the typical range that we will experience. And so, again, very quiet day. You can chalk part of that up to us heading into the holiday season, I suppose, and some traders already starting to unplug a little bit. As a matter of fact, this will be my last market outlook related video here in the year 2019, as starting next week I'll be off on the road and traveling with my family. So anyway, I imagine there are a lot of people on Wall Street that are starting to think about their vacation time coming up here as well. So quiet session, all things considered, but also a constructive session when you consider the new highs that were hit. You can see here on the S&P 500, while we didn't close at a new high, on an intraday basis, we did hit a new high. You can also see we hit a new all-time high on the NASDAQ composite here, and in this case, we actually closed at a new high as well, since the NASDAQ finished slightly higher today. And then on the Russell 2000, we did hit a new 52-week high. However, we're not quite to all-time highs on the Russell 2000 yet, but nonetheless, it has been a very strong rally that we've found ourselves in here for the last couple of months, and that for the most part has continued. As you can see, our bullish postures remain intact, just as was the case yesterday and for much of the last couple of months. And in fact, we do have some bullish intermediate confirmation signals for the second straight day. You can see that the red line on the S&P 500 is down below here. Now, yesterday I noted that there are different ways to determine whether a bullish intermediate confirmation signal is more ideal or less ideal, and I was mentioning that the blue line was not down below 50 and above 20. It's still not. In fact, I'll throw one more fly into the ointment in today's session, in that the red line is way down here, nearly at zero. Sometimes when that red line goes too low, it's a sign that it wants to change the market direction. So we'll have to wait and see on that. But for right now, do know that technically we do have a bullish intermediate confirmation signal on the S&P 500, even if you wouldn't consider it to be an ideal setup. The Dow Jones Industrial Average is a little bit closer to that ideal setup on that signal, because here you can see the blue line is almost down there below 50. It stopped short just barely. Notice that the blue line is at 54 right here, so again, it's not quite there, but it's at least closer than what we saw on the S&P 500. And in the case of the red line on the Dow Jones Industrial Average, you'll notice that the momentum line here is at 6. So if it's below 5, we start to view that as kind of an extreme move. In this case, it's still above 5. 2.5, and so it would kind of fall within the lines of a more ideal setup there. But we'll have to keep our eyes on that going forward. And then we had that signal down here on the NASDAQ composite as well. But again, the blue line is not exactly where we want it to be. So for the second straight day, we have a bunch of bullish intermediate confirmation signals. And for the second straight day, none of them would be considered ideal. But who knows? Maybe they can give us a little bit of Santa Claus rally heading into the end of the year there. You will see that the Russell 2000 was the best performer here today. That small cap index was up 0.25%. And as you can see, touched a new intraday 52-week high along with a closing 52-week high. All right, moving right along now to our 3 green arrows setup, and that will be chart 4D. As it stands here, nothing changed from yesterday, so I'm not going to belabor the point. Basically, we've got 3 green arrows across the board. So not only do we have bullish postures according to the market forecast intermediate line, we also have bullish 3 green arrow signals on all 4 of our charts with upward trending 30-day moving averages. So if you didn't know it by now, it's been a good time to be a trend trader. And if you're going to find stocks that repeatedly go up day after day without having seismic pullbacks along the way, those are generally very good trend trading conditions. And so that's where we found ourselves for much of the last 2 months or so. Let's go ahead and now take a look at our longer term chart. And in this case, this will be chart 4C. It's our 1040 crossover method. And as you can see here, everything is passing with flying colors, at least if you're a bull, which I would have to believe most of you are, as we do see the orange line above the blue line in all 4 of our charts here. So the 10-week moving average is continuing to be above the 40-week moving average, and therefore we have a bullish longer-term posture at this current juncture as well. All right, moving along now to some of our 12 grid analysis. Let's take a look at our asset classes here today. And as you can see, we've got a variety of interesting charts to look at. One thing that did catch my eye today is that real estate had a pretty interesting bounce back. Take a look at that candle right there on VNQ. It was up over 1% today, but things looked pretty ugly to start the session. So that's why the candle looks as though it did. It started the day gapping down and then rallied all the way back to finish a bit higher there. So anyway, the downward movement and the downtrend is still in play, but keep your eye on that. Sometimes it takes a very erratic candle to start changing the shape of the chart and start putting in a bottom. I don't think we're anywhere near that yet on the REITs unless things change from an interest rate perspective. But nonetheless, I did want to point out that candle so that way you were at least aware of it. You can see that interest rates actually rose here today. They were up 1.8% and ended this session, at least in the 10 years case, at 1.92%. So that has been quite an interesting story to end the year, is the rally in interest rates. You will see that high yield bonds went up yet again. I mentioned that one yesterday as starting to really be peculiar in that it seems like high yield bonds have been going up day after day after day after day. So these are junk bonds for those of you that are more familiar with that terminology there. But that's been an area that has benefited by seeing oil prices rising. And once again, oil was up here again today if you use USO as your proxy. So when USO goes up, high yield bonds have a better tendency to outperform on a relative basis versus other bonds. And you can see in the case of the foreign bonds, they were actually down today. You can see in the case of the long-term U.S. Treasury bonds, so this kind of the safer bonds in the United States, they were down today as well. So high-yield bonds bucked the trend of other bond markets and actually finished higher. And I think a lot of that is kind of risk appetite right now is strong, and the connection to oil certainly doesn't hurt in this case. You will see that the U.S. dollar has rallied for the last couple of sessions. We now have a weekly bullish posture on the U.S. dollar, but we still are below a falling moving average, and that's why that moving average is red in that case there. So kind of more of a sideways choppy pattern there on the U.S. dollar more than an entrenched trend that we find ourselves in here currently. You will see that the developed foreign markets did pull back for the third straight day today if you're using EFA as your proxy, but note that it does continue to have a strongly bullish posture and we remain above a rising moving average. Foreign stocks from an emerging perspective actually had a pretty solid day. EEM was up 0.54%, and we are approaching multi-month highs there as well. In fact, if you look at it at this exact moment in time, you'll see that EEM is actually leading at this point, because from the last 3 months perspective, this little label off to the right-hand side here will show us that EEM is up 6.61% over that 3-month period, whereas EFA is only up 5.56%, and the United States in the form of SPY is only up 6.14%. And again, that's a good sign, that's a healthy sign for risk appetite when we find emerging market stocks starting to outperform here. All right, let's go ahead and move on to our next set of 12 grids, and this will be our U.S. sectors. See what happened here in the United States, at least today. And you can see we had a little bit of a color change. Yesterday, I was noting that the real estate space was in the red, whereas all the rest were in the green. Today, you can see real estate actually flipped back to a green background. Now, it's a light green background. Notice that the intermediate line is at 20.29 and rising. Most of you that are aware of the market forecast indicator kind of knows what the rules state regarding bullish versus bearish. And when you're below 20, you're bearish automatically because that's considered the lower reversal zone. Once you emerge above the lower reversal zone, then you're starting to be considered bullish, at least weekly bullish, until you cross above 50. At that point, you would then be considered strongly bullish. So anyway, we just barely got above 20 here. So don't hold your breath there. Remember, if real estate were to fall tomorrow, even just slightly, there's a good chance that the intermediate line would pop back down below 20, and this chart would flip right back to pink. That's especially worrisome considering that real estate remains below a falling moving average at this point. So just be careful with that one. It's a good starting sign to see that we had a posture change, but price is still a little bit nerve-wracking in a downtrend there. In terms of the one that flipped from bullish to bearish, that was actually industrials. Many of you have been following the story with Boeing here, of course, recently, as it has struggled to keep up with the rest of the market as a result of some of its own policies that are going on. But I mentioned in the intro one very important company that maybe doesn't get talked about a whole lot, but is an industrial company. It's FedEx, ticker symbol FDX. And as you can see here, that thing got absolutely whomped today on its earnings announcement. It was down 10%. That's a massive move for that scale of a company right there. So it shouldn't be entirely surprising to see industrials suffering on a relative basis today. You'll see that it was down 0.42%, which was tied for the worst performing sector of the day. And then in doing so, that was actually the 4th straight down day for XLI. We now find ourselves on XLI below a falling moving average there all of a sudden. So we'll have to keep our eye on that, because prior to this week, industrials had actually been one of the stronger performing areas out there. But now with this Boeing news and what's going on with FedEx, you just never know when the temperature and the tone of a particular sector starts to change. And we might be seeing that take place right before our eyes here with industrials. Much of the other sectors were holding up reasonably well here today. I'd like to point out communications as being kind of a star today. Now remember, communications is a bit of a funky sector. It is made up of the old telecom companies like AT&T and Verizon, and then it's made up of the new internet companies like Facebook and Google/Alphabet. There's not a whole lot of components to the communications sector, and if you were to look at it on a case-by-case basis with the components within the communications, there's actually not doing that well. What you will find when you kind of peel back the layers of the onion is that the mega cap names within communications are doing quite well. As I mentioned, your Facebooks and your Googles, and I think even AT&T was up today. Yeah, AT&T had a pretty nice day there. Facebook had a really nice day, up 2%, and then Google was just basically flat here today, but had been in a sizable uptrend. So anyway, communications from an XLC's perspective, which is market cap weighted, looks very strong. However, there are a number of communication individual stocks that are much smaller companies that are not pulling their weight right now. So just be careful when you get into that place. But from the mega cap communication stocks perspective, things look pretty strong here. We were up 0.68% today, and I'd have to believe a lot of that was as a result of what was going on there with Facebook being one of the most important components within that particular ETF. Let's go ahead and move right along here to our next 12 grid. Check out the global stocks now. And this is chart 5E. These are some of your major economies around the globe. And as you can see, we've got a couple of pink charts on the board. Canada, which I mentioned yesterday as being in the pink. And then we also have Japan all of a sudden. That's a little bit new. Japan had been one of the strongest areas of the market going back not just over the last 3 months that we're looking at on the chart here, but even beyond that. If we were to kind of look at, let's say, a 6-month chart, this rally that we've seen in Japan really started in earnest here back in August and has been one of the stronger charts out there. So eventually you got to give back a little of those gains, and that's perhaps what we're going through right now with EWJ. You'll also notice here on Japan, we had a couple of these red dots show up on the chart here recently. Those signify overbought cluster signals. Sometimes those work, sometimes they don't, but since they are showing up at a time where Japan is starting to roll over a little bit, it does become a little bit more worrisome there at near the end of an intermediate type of a run like we found there. So, this may be a time for those of you that had been, trend trading Japanese securities to start tightening up your stop losses or, limiting your risk possibilities going forward in that particular area, because we are starting to see a little bit of stress on the Japanese market. Some of the other markets are hanging in there just fine. In fact, we'll be talking about one of them in my trade application example here a little bit later, so I won't spoil that for the time being. Let's go ahead and just mosey right along here to our secondary global stocks, and that's chart 5G. And here you can see we've got a few more pink charts that are showing up. Remember, yesterday in the presentation, only Saudi Arabia was considered to be having a bearish posture. Today, you've got 2 more joining the party there, and that is Australia and that is Spain up here at the top. Now notice with Australia, it's a little bit more concerning because price is now below a falling moving average. With Spain, yes, it's a little bit of a weak posture that we've seen here with a pullback in the last 4 sessions, but we still remain above a moving average that could easily be used as a support bounce area when push comes to shove. So of the 2, I'm a little bit more concerned with what I'm seeing there with Australia, and maybe something going on there in the Far East with Japan weakening and now Australia weakening a little bit as well, whereas we're finding a little bit more strength elsewhere around the globe. You will notice that Switzerland remains strong on that bottom rung down there, hit a new multi-month high here today. That's EWL for those of you that want to track Switzerland at home on your own. And then Argentina, which I brought up yesterday as well, had another stellar performance today. It was up 1.6% and hit a new multi-month high as well. Of course, Argentina has a long ways to go to hit yearly highs, as that was the country that really fell out of bed earlier in 2019 with one of the biggest gap downs in history. And it's starting to just give us a bouncing type of a pattern off of an extreme low that it produced here earlier this year. Taiwan remains in a strong uptrend, and Sweden does as well. So those bottom charts there all continue to look pretty promising. All right, let's go ahead and now check out another set of 12 grids here. Let's go ahead and see what's going on with chart 5I. This is the fixed income 12 grid in this case. We don't talk about this one quite as much because these are generally a little bit more boring from a market perspective, as bonds don't typically move around with as much exaggerated movement as stocks do, but nonetheless worthy of a conversation every now and again. The main takeaway is what I've already mentioned when we were looking at our asset class 12 grid, which is, the strongest of these charts to me right now appears to be high yield bonds, and that's a good sign for risk appetite. I would also say that convertible bonds down here on the lower rung also looks quite appetizing, and this is ticker symbol CWB for those of you that want to track that part of our financial markets. But remember, convertible bonds will typically be corporate bonds that can be converted into common stock and also can represent a fairly decent risk appetite, at least in comparison to what's happening with government bonds. And so it's good to see that convertible bonds are in a strong uptrend with nice higher highs and and higher lows. In addition to that, a very strongly trending moving average right there. Whereas kind of in the middle rung here, where we see our government securities for the most part, we've got SHY for our short-term treasuries, IEF for our medium-term treasuries, and then TLT for our long-term treasuries. Those charts all have a downward tilt to them. We do have the short-term treasuries doing fine from a posture perspective, but you can see the moving average is tilted lower, as is the case with medium-term and long-term treasuries there as well. So it does seem like this market desires to be in a few of the riskier areas right now and is leaving government bonds in the back seat for the time being. Let's go ahead and move along now to another set of 12 grids. Let's go ahead and check out our 5K chart here, and this is commodities 12 grid. So I mentioned before that oil had started to come alive here more recently, and that's the chart kind of second to the top right there, USO. Notice that it hit a multi-month high today. Oil is very important in terms of the full commodities complex as well. It's going to be probably the most important and largest component of something like DBC here, which is the commodities index. That's going to include all commodities. And even from that perspective, commodities look pretty strong here. DBC is hitting a new multi-month high here, and that's a good sign for risk appetite as well. Natural gas is actually in the doghouse. So despite oil doing well, natural gas continues to be basically thrown away by traders, and a lot of oil companies just simply flare their natural gas and just burn it off because it's not worth their hassle to sell it. We've got so much of it here in the United States. So you see that UNG continues to be mired in a pretty significant downtrend there, but gasoline is on an uptrend. And gasoline, of course, doesn't really benefit us as citizens all that much, since it means more money out of our pocketbook whenever we go fill up our gas guzzlers out there. Nonetheless, it is a sign of a stronger economy when we see that type of behavior more often than not. You'll also find that copper has been doing pretty well here recently. That's the chart off to the right-hand side. I would also say that sugar is in a significant uptrend, and then also coffee has been in a significant uptrend there as well. All right, real quick here as well, over on our website, if you go to marketscholars.com, remember, for those of you that are premium members, you're welcome to check out our classroom offerings. Earlier today, I taught my swing trading class, where we did a somewhat rare short selling trade. In that particular class, we opened it up to the opportunity to go either long stocks or short stocks, and looking for specific trading setups. Today, the class actually voted for the the short selling swing trade setup, which is somewhat rare for them. So if you're interested to hear which stock we were shorting in that class earlier today, feel free to check out that recording that is now posted on our calendar. And then David had his options inventory class for those of you that are premium sellers out there, and if you want to learn how to manage your options inventory, feel free to check out that recording. Tomorrow I will have my Q&A session first thing in the morning. That's 11 a.m. Eastern time. It's 9 o'clock out here in my time zone, in the Mountain Time Zone. And then David will be hosting his portfolio management with ETFs class in the afternoon. So make sure you're checking out all of those resources that are available to you if you are a premium member of Market Scholars. All right, so let's go ahead and get into our trade application example here for the day. And I'm just going to come on over and take a peek at chart. Let's just do 4A in this case, just a normal market forecast 1 grid. And I mentioned it's going to have a little bit of an international feel to it today, and it's going to be a little bit more speculative as well. So just be aware that it'll be a lower probability trade, but yet one that has some valid arguments going in its favor. So let's go ahead and take a look at EWG in this case. Now this is Germany, at least from the United States' perspective. Remember, if you live overseas and you are watching this YouTube video, there are probably other ways to play this, but here in the United States, we are somewhat limited in our available securities if we wanted to play the market of Germany. And in this case, EWG will suit us just fine here. Now, what caught my attention with this particular security is it was one of those markets that is giving us a bullish intermediate confirmation signal at this moment in time. Now, again, it's not ideal, but at least it does exist. Notice right now we have a green background color of the chart telling us that the Intermediate line is considered bullish, so that's check mark number 1. Check mark number 2 to look for if we're looking for a bullish intermediate confirmation signal is for the red line to be in the low reversal zone. Now, ideally, you don't want that red line below 5. We're awfully close there because here you can see the red line is at 5.56. Nonetheless, it is above 5, so that is not as big of a concern. The blue line, as I mentioned earlier in the presentation, we'd like to see between 20 and 50. And there we do have a little bit of a fly in the ointment. As you'll see, the blue line is below 20 in this particular case. So again, not an ideal bullish intermediate confirmation signal, yet it does exist. So it's just a matter of are there other features of the setup attractive enough to kind of overrule the argument, so to speak. And what caught my eye with this one is kind of the idea of old resistance becoming new support. Some of you might think of it as a breakout retest type of a mindset when it comes to technical analysis. So if I were to get my drawing tools out here, and if I were to draw just a price level here, and if I can draw it somewhat straight, there we go, you can see what I'm referring to, at least I hope you can. Notice on this candle over here that I'm kind of circling with my mouse, this was back on November 4th, and then another candle right here on November 19th. We're basically pushing right up against that blue line that I've drawn on the chart there, and it rejected that area. So we had a bit of a double top during that time period there that existed where EWG just simply didn't want to get up and through that level despite its moving average consistently going higher during that era. So that stock, or in this case the ETF, ended up being in basically a sideways trend. You could probably draw another line somewhere down in this vicinity right there, and you can kind of see that, from basically the beginning of November until the middle of December, here just a few days ago, we were basically trapped somewhere below this upper blue line at around, let's call it 29.25, and somewhere above this lower blue line, somewhere above 28.60. We were stuck in that box. Well, we finally broke out of that box here on the 12th of December, and we continued to go up for a couple of days after that. Now, it looks like that this chart kind of exhausted itself to a degree because for the last couple of sessions, it's actually been pulling back. But lo and behold, where did it pull back to? It pulled back to exactly where we had that double top before. Now, we don't know if we're going to bounce from here, so that is one thing to consider, right? It ended here because they rang the bell. Who knows? Maybe if they didn't ring the bell for a few more hours, this stock would have continued to travel even lower. But as it stands right now, here on a Wednesday afternoon, it appears that it stalled out exactly where you would want it to if you believe in that technical analysis theory of old resistance becoming new support and this breakout retest of the old breakout level taking place here as well. So the hope at this point is that we get a bounce from these levels going forward. And again, with the market forecast giving us a bullish intermediate confirmation signal, at least we have some sort of a reasoning in the back of our mind as to why that could unfold going into 2020. And so what I thought we would do today is a more speculative trade. It's a more simple trade. A lot of times you'll hear David and I discuss kind of spread-based trading, but today we're just going to do a simple buy a call option. Just keep it nice and basic here today. But in doing so, I want to remind you that when we buy call options or put options, anytime we're the buyer of single contracts, we are taking low probability trades. So you should use those types of trades somewhat sparingly in situations where you feel maybe a little bit more optimistic about the results, or you just want to take a little bit of a flyer and not spend too much money on it, and that could represent this situation. If we come on over here to the trade tab, you'll see that if I pull up the January contracts that expire in 30 days, and we come on over here to the 29 strike, which is considered the at-the-money strike right now with this ETF trading at $29.26, you can see that we would be able to buy that for about 60 cents right now. This is also the most liquid of the contracts that are available in this range as well, at least here on the call side. You can see there are 1,600 contracts there in the call side of the equation. So that might help you get in and out of this trade if that is important to you as well. And, when you buy a call, like we are looking at for this paper money example here, you can basically take how much you're going to spend on it, in this case 60 cents, and add it back to the strike price, in this case $29, and that would effectively be your break-even price. So if you think that EWG will be above $29.60 in 30 days, then perhaps that could be an attractive opportunity for you. So let's go check the chart and see where $29.60 is. You'll see that $29.60 is basically just back to where we were trading 2 days ago. So if you think that this stock is still in an uptrend and has a greater chance to go higher in the future than lower, then asking it to just go back to where it was 2 days ago at some point in the next 30 days shouldn't be a big ask out of this particular security. So again, it's not a guarantee that's going to happen. Obviously, anything can happen in the future, but at least you can be justified in thinking that the possibility exists. You're not taking some sort of an exaggerated risk here. Having this security go back up to this candle and then beyond it, if this trend were to continue to be in the upward direction, is a reasonable expectation. So let's go ahead and place that speculative trade here by just simply clicking on the ask price. Coming on over here, I'm just going to do one contract in paper money just to show you the philosophy here. And then I'm going to try to get this filled tomorrow at 60 cents, or right in between the bid and the ask of the close here today. And so I'll go ahead and click confirm and send, and we'll ship that off and see if we can get filled first thing in the morning. All right, well, thank you for joining me here yet again. This will be my last presentation of the decade. How about that? So I'll see you guys all back in January after the holidays. I hope you all have a great Christmas and Hanukkah and all the other holidays that are out there. Enjoy your families, enjoy your loved ones. Be thankful for what we have accomplished in the market this year, and come back in 2020 refreshed. Remember, David will still be with you for the next few days, but do want to say goodbye to those of you that are not premium members. For those of you that are premium members, I'll be teaching my classes through Monday of next week as well. So I'll see many of you there. But in the meantime, best of success with your trades and your investments. Goodbye for now.